You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear.
All right, folks, welcome back to today's footwear podcast show, Shoe and Show. I'm your host, Andy Polk, and along with me is the other host, Matt Priest.
Yo, yo.
Brothers in arms, fighting for footwear fairness across the world through FDRA. Today's episode, is really focused around the challenges that we see in the marketplace and more broadly. And I think it touches footwear workers, it touches our companies and strategies, it touches our consumers, and it extends all the way around the world to those making footwear for the consumer. And it's not just about inflation. I think there's just a lot of churn that's happening in models and marketplaces, still caused by COVID. I think we've kind of forgotten, that COVID, some people have forgotten that COVID exists in many ways, and it's still popping its head up around the world. And then you got conflicts, just like COVID conflicts, complexities. I don't know another C word, Matt, to add to this, but to make it work. But it just seems like there's so much churn. There's just so much churn. There you go. Boom. That's happening. And I think that's what this episode is really about. It's just unpackaging some of that.
Yeah. If you think about all the once in a generation things that hit the industry, hit our society, and now we're kind of unwinding those things, or now that we've kind of put out the fire in the house, we're surveying the damage and trying to figure out how we rebuild. And that is chaotic. That there's a lot of churn with that. And one of our key allies in helping us kind of dissect the data and understand how to better forecast and understand what's going on to the industry as a whole is Gary Rains, who's our chief economist. Gary, you've been on Shoe and Show a number of times. Welcome back, my friend. As you listen to Andy's opening and his multiple C's, what are your thoughts as we kick off this conversation about what's happening in the footwear marketplace as we sit here now in April, May of 2022?
Yeah, certainly appreciate the chance to be back on. A couple C's I would maybe add is consternation, chaos, confusion. It's really been trying times, with everything from the record volumes of shipments we saw last year. Of course, the record demand for footwear. In turn, with that record demand, of course, we saw this record increase in footwear prices as we've seen more and more inflationary pressures across the broader economy. That rising tide has raised all ships, including footwear, and we've seen footwear prices increase at the fastest pace in decades, really. And I think that's contributed to that consternation I was talking about earlier. It's really a market that few of us have been in, dating back easily 4 decades, and I think it's going to be a trying time in 2022 as we see the fallout from this record demand and the record availability of really cash in the economy, as the government had thrown so much stimulus to try to help the economy pull itself up by its bootstraps coming out of COVID over the last 2 years. And that's I think introduced a whole new dynamic into the market that none of us have really seen before.
Now, some of the data that we've been reviewing lately, Gary, is, and clearly we're heading into COVID, there was this movement towards e-commerce that was relatively dramatic, but pretty steady. And then through that, COVID was an accelerant on that activity, on that buying activity, particularly for generations that weren't buying e-commerce before. Baby boomers come to mind. Now that the waters are receding and most economies are open back up for the most part, it seems like brick and mortar is the empire striking back, if you will, and some of those trend lines that we're seeing before on e-commerce are starting to recede a little bit. So how do you think about that as you're thinking about a consumer that's getting pounded by inflation and is getting pounded by this chaos and consternation and all the other C's that we can come up with to form a drinking game for our podcast? How are we supposed to digest that, right? How are we supposed to think about more and more people getting out and buying? And are we long on the tooth on all this? When's the whole thing going to come crashing down? Or maybe it won't.
Yeah, that is something we've been watching pretty closely in 2022 as we see maybe COVID on the wane. Certainly, we hope so, and I think more and more people, venturing out. We're seeing more and more people returning to brick and mortar, and certainly brick and mortar shoe stores along with it. While that's wonderful, it has come at the expense of maybe some of that reallocation away from e-commerce. As you said, over the last couple of decades, we've seen e-commerce accounting for a growing share of the market, just about year after year. And as you said, that it really had accelerated during COVID with more people staying at home. The e-commerce share of the market really had spurted higher. And we're seeing some of that retrenchment now with more and more people venturing out. That's great for brick and mortar, but e-commerce, unlike the long-term trend, e-commerce share of the market is really tapering off in 2022. And that's something that I think is likely to be a continuing factor, much deeper into the year, assuming COVID, remains kind of on the back burner.
Yeah, I have some thoughts on this too. Obviously, I mean, it is pontification, right? So I look at it. If we can drill down a little bit and kind of dig in on this, I see a lot of e-commerce around brands, right? So like people will go and buy a shoe online that they already like know the sizing, right? A Nike, Adidas, a Steve Madden, or whatever. They have a general idea what the sizing is, so there's trust in that space, and they know like the kind of the fit, the feel, the quality, and like me, I know exactly what my size is and different things, and so I'll reorder a pair of shoes that are similar, and then but I think a lot of it is driven around brand, and I think a lot of what's happening now in the marketplace with brick and mortar is around like private label shoes or like off price shoes, right? Like people are looking for price points that are a bit lower. So maybe it doesn't have a brand logo on it, but it's something that satisfies their need, or they'll buy a branded shoe, and then the second shoe won't be branded. It'll be something else. They're definitely adjusting what they're doing. We did a spring survey and just asked people what's happening, like how are they changing their habits based on inflation and higher costs. And some of them are basically nearly 50% said they're just shopping less or putting off purchases. But the people who are shopping, they're talking about going to discount retailers to find better deals. So I mean, like TJ Maxx, Marshalls, Burlington, places like that, where I think people are just looking for deals for brands. But I do think there is something to, and this is something we could research. No one really knows, because Gary pointed out we're in this weird space where historical data can help a little bit, but it's everything's so murky we don't really know. But my assumption is when you start to see economic challenges, we're not in a recession, but it kind of feels like we are, because we're a little bit the dollars we have in our pocket are more costly, right? It takes a lot more in our pocket to make a purchase of something. And so people are starting to change a little bit around that. And I feel like when that feeling starts to happen, you go local to look for better deals maybe than look online, because you're going to buy online probably a brand over some footwear you've never had before. So I don't know what you guys think about that, but I think there's something to that in terms of being conscious, and maybe there's something too about having money in your hand and making a purchase in person versus doing a purchase over the internet in a tough economic time. I don't know.
Yeah, I think there's some truth to that, Andy. And having been particularly to the off-channel retailers you just spoke of a lot lately with my kids as they're hunting for prom dresses, for example. There is something really interesting to see about how the consumer is changing and the way they love that treasure hunt. I hate the treasure hunt, don't get me wrong, but those off-price retailers, they play that up because there's this aspect of wanting to find that deal and wanting to find that treasure, but also still being anchored to brands, right? Not going into some kind of generic hole. And that's why even some of the mass retailers have brands, right? They brought in brands into Walmarts and Targets because they wanted to kind of anchor that into the buying experience. And then you go into those off price and they kind of sell it. Welcome to the treasure hunt. It's like on the wall, right? It's a part of the consumer psychology. And so you think to yourself in an inflationary time, the desire to want to do that is going to be even more, right?
Yeah.
The desire to feel like, at least emotionally feel like you have a deal, it's going to be more. So I think that's right. I think there's an aspect of that, getting back in the store, but also being hit by inflation. So wanting to find a deal, but wanting to have brands at your disposal. And I think all that is a mixture for the success for the off-channel people.
Yeah, and I mean, to the retailers, I do wonder. I mean, obviously, retail doesn't always share data, but I wonder if they look at it and they look at their numbers and they say, branded footwear sells, 80% of shoes we sell online is branded footwear. So we need to create brands that fill that channel. But most of the shoes right now in store, yeah, there are brands that sell, but like that's where we get a lot more private label sold or wholesale unbranded shoes because they're better price points. So I think that's the challenge now in the marketplace, right? It's like finding the right fit of your shoe and what the channel is for that and like how you market. Because even that, like marketing for e-commerce is going to be a little bit different than marketing for in-store, right? Getting traffic in and then trying to get somebody to buy the extra pair while they're there and spending more time perusing the store and adding value in some other way, like whether you're doing orthotics or whether you're, give them a cup of coffee or it's a balloon show or something like that. I don't know. But I think that's the challenge of the brick and mortar is like having that right balance. And that right balance is very different than the e-commerce channel. But still, I think the other challenge that we look at too is the inventory. And it's just like, Gary pointed out, we had record imports and those continue and we got record prices. So it's like in a marketplace is simply this. It's where a buyer and seller agree to a price. It's not any harder than that in economics. That's the definition. But that's the question is where they're agreeing on the product and the price. And that's the churn of wondering like how much inventory is coming in. How does that person want to buy it? Are they, if this is true and there's, 50% are saying I'm going to put off a purchase, like how do you make them buy it right now except for discounting? Right. Like, and that treasured, whatever it is, there's got to be some like new creative way that we haven't like stretched our muscles since 2019 or 2018 on how we deal with some of this stuff.
Yeah, I would agree. The old cliche of retail therapy, in my house at least, it does not apply to me. It is. I'd rather take a beating than shop, and certainly to shop at great length. My wife, however, exact opposite. It is very therapeutic for her to go out on that thrill of the hunt to try to capture that next bargain. And I think in this environment of increasing price pressure, really across the spectrum, not just limited to footwear, it's going to add a whole new layer of complexity to her hunt for that. Me, typical guy, I go and buy and get out as soon as possible. She, loves to go and spend hours. If she doesn't buy, she shops, and that's I think the delineating difference between the two of us that is perhaps not that different than maybe between other men and women, that the men buy and the women shop on whole, on the balance. And that's something that I think is going to be a big challenge for both consumers and retailers in 2022. Is that thrill of the hunt? Looking for that discount, looking for that on sale. Item is not going to be as prevalent as it was pre the inflationary spike we're witnessing now.
So, Gary, there's been talk about we might be hitting the inflationary ceiling right now in the spring of 22, but deflationary opportunities are probably not going to be around for quite some time. What are your current forecasts as it relates to what pricing is going to do, and then where do we go from there?
Yeah, that is really the $64 question. There is a large consensus of models.
That $64 question now costs you $78.
That's right. Exactly. There's a pretty big consensus among economists that we're pretty close to seeing that high water mark for the year-over-year increases in prices. That is essentially inflation itself. While the rate of inflation may slow deeper into the second half of 2022, on the whole, for the year, inflation is still going to be unlike anything we've seen in decades. Not just because of the spike we're witnessing here in first, second quarter, but I think for the full year, even if we see inflationary pressures begin to taper, instead of growing 6, 7, 8%, if it only grows 4 or 5%, well, that's still phenomenal. That's still beyond anything we witnessed in decades. And I think for the year as a whole, we're still going to see full year prices across the broader spectrum, the broader economy, increase at the fastest annual rate in years. So yeah, even if there is that deceleration, I think because of the damage done and the likelihood that those prices are still likely to see pretty steep year-over-year increases through the second half of the year, full year prices, I think, are going to increase at the fastest annual rate we've seen in decades.
Yeah, I mean, as an armchair economist, not a real economist, just armchair, just, shooting bullets out there, it just feels like we're on a different plateau at this point. It feels like because there was so much money pumped into the economy, we had so much churn and supply, and there's so many different variables, including the fact that we had several decades of flat inflation because of productivity increases, technology increases, things like that, and just a general environment of really good international trade and comparative advantages across economies. But it feels like the epic was changing because of COVID. And I feel like the international model of trade and comparative advantage is being rewritten because of the war in Ukraine. And obviously, when we talk about war and what's happening, there are a multitude of wars happening around the world. But most of them are not happening on the border of first world countries, and certainly not with nuclear weapons. And they're certainly not being backed by another partner where we source most of our materials and products from. So it makes a real interesting, complex challenge to the international system and how we perceive our economic growth and our economies around security. And I think we've been driven by economic considerations in international relations for decades, and now we're starting to flip that to security, and that's going to create a range of different issues for trade, supply chains, et cetera. But, I think it's both in terms of in the U.S., there are structural changes, wages increased, we have more competition for jobs. So pay is going to go up. When pay goes up, pay's not going to go down. So there you go. Inflation's built in there. When trade starts becoming so disruptive, and you got to pay more wages in China for workers, you got to pay more in Vietnam for workers, you got to pay for more materials because the risks are higher longer term. Those don't go down. I'm not saying they're going to go up substantially, but that's why I say we're on a different plateau in terms of inflation, and we may hit a high water mark and it may blip down a little bit, but I just think we're going to be in a different epic than we have been in our economy, the whole economy, not just footwear, but the whole economy. And I think part of that too is being able to pass on the prices because there's socialization to the higher prices, right? Eventually, Americans get used to paying higher prices. They don't like it, but if the gas goes from $4 to $3.50, that $3.50 is still higher than $2.50 last year, but they're less likely to complain about it and just deal with it at that point because they've been socialized to the higher prices. So there's just a lot of, I don't know, when we talk about complexity, that's what I think of is like, it's just different. It's a different mentality. And even for my own budget, I'm like thinking and retirement and all that. It's like, I got to rethink all my models for savings and outlays and like things like that, because the inflation over the next 10 years is going to be continual, I think, because we're in that new plateau, if you will.
I agree. I see three contributing factors to this inflation, and only two of them, I think, are likely to last longer term. The first one, of course, as we've talked about earlier, with the record demand because of so much stimulus, thrown into the economy, that has spurred a lot of price pressure. We've been talking about this for months, that there was this potential to see increased price pressure, further down the supply chain, in the coming months because of all this stimulus thrown into the economy. A second factor, exactly what you mentioned, wage pressure. With the unemployment rate so low, naturally that has contributed to driving up wages. And Andy, you're spot on that once wages go higher, they are not likely to come back down. Someone's not likely to say, "Oh, it's okay. I don't need to make X dollars an hour. I'm willing to take some amount less than X." That is not going to be an issue at all. The third factor is the only one that could come down, and that is manufacturing costs, particularly commodity costs. Now, a good chunk of that is driven here recently by the conflict in Ukraine. But even before that, we had been talking for a number of months about increased cost pressures across the manufacturing supply chain for footwear. Looking at a range of different commodities, how those costs have only tended to increase sharply higher. While we could see those costs retreat, the first two factors I think are not likely to contribute to any kind of erosion in retail prices anytime soon. So I think at the end of the day, I think we're likely to see this inflation, while maybe taper for the full year. I think in 2022 and on into 2023, inflation is going to be higher on an annualized basis than anything we've seen in the last couple of decades.
Well, let's talk then about the government's slowed approach to trying to tamp down the inflation with rate hikes. And I love the analogy that you use, Gary, on if inflation is cancer and chemotherapy are the rate hikes, right? You're basically trying to kill the inflation by slowing the economy down and somewhat making the economy sick in order to get to a recovery point or to kind of help things cool down. But if they're late to the party, as we've argued that they are, and they're still going to be, over the next 12 to 18 months, having 8 to 9 rate hikes of certain, 25 to 50 basis points, then how is that going to play out into all this? How sick do we have to get the economy to level set it? And I agree with you, wages aren't going to go down. In fact, even with wages going up right now, there's a help wanted sign in every single business in this country. I mean, literally every business has a help wanted sign. So how does that all wrap together when you're gonna kind of bring the economy into negative territory in order for it to ultimately grow back into positive territory?
Yeah, I think that is an issue that is going to haunt the Federal Reserve really for the next year, 2 years. The writing is on the wall that the Federal Reserve's Federal Open Market Committee is set to increase rates aggressively, arguably at a sharper, steeper pace than any time really on record. And that is really a mouthful to say right there, that the Fed is going to go from a very accommodative monetary policy to a very restrictive, hawkish stance in just an unprecedented short period of time. And I think as we see these, 25 or 50 basis point rate hikes every 6 weeks, really for the next, 12, 15 months, I think that is going to cause a big shift in not only the broader market, but even consumer mindset, that they're going to see rates go much higher in a very short period of time than anything we witnessed in the last couple of decades, and that I think is going to be an issue that is going to, I think, haunt the broader economy and certainly consumers' sentiment, consumers' mindset as we get into 2023.
Yeah, I'm also concerned more broadly with our workers, our workforce, and just with general consumers, with that new plateau of what interest rates do, right? So if we're already at a new plateau because of input costs, the wages, and you can break out your bill of cost, right, and like see where all those things are, and you could, as a business, you can look to say, okay, like this is going to be this way for 10 years, and it just is what it is. Where can we optimize and change through our business model to find cost savings? A lot of that's been done during COVID. We trimmed a lot more fat during COVID. There's not much more in a current model that we can do in a lot of these kind of cost issues. And that's why we were always barking at the federal government to be like, this is not transitory. There's nowhere else to hide. So I think there's that point, but I also look at challenges with the interest rates and mortgage costs. So obviously when people are looking to move or sell and all that, when they're buying, the cost of cars and the cost of houses is going to be higher. And there's nowhere to hide when those interest rates start going up, because they were, a year and a half ago at like around 2.5 to 3%. Now they're bumping up 5 and greater, and that's several $100s out of the pocket more each month, typically for a family. And then you add in the energy prices, both heating the home and electricity, and then also gas, because we see the European Union talk about like divesting from all Russian energy, which creates market dynamics that we've never seen in terms of, I mean, Russia's a huge energy supplier to the world. And so all of a sudden you're looking at long-term gas price increases in Europe and possibly here because of lack of supply in that. And so I just, I look at those things and I'm like, structurally, those are two huge challenges because of interest rates and because of global dynamics that really impact pocketbooks. But I also see a lot of innovations coming in around artificial intelligence, a lot of people moving more to cloud to see different things, but those things are still, I mean, we haven't mastered the digital space we have now. I mean, I look at websites and I'm like, this is the best you got. I can look at it. I can click through the shoe and see that side, and that's it. Like, what else you got? Like, we haven't mastered optimizing our digital space. We haven't mastered optimizing our retail digital space. It's good, but we haven't really integrated the tools and understood how to really communicate things to consumers virtually in and of itself. And the AI and the technologies that would seem to provide deflationary pressure, just like we saw with, like, let's say Microsoft. It took Microsoft a decade or so to really create Office Suite that actually helped optimize and decrease costs across business units. And I think that's where we're at too. So there's positives, but I just feel like we're in a situation where 5 years is going to be very inflationary, maybe a bit longer, until we start to see, back to where we were, like a flat line, because that is the only solution to some of this stuff is you drill more oil or you create more electric vehicles on that side. And then for our companies, it's like, what's the next technology that optimizes and cuts out processes and touches and labor to reduce cost? And I think that's just what we're looking at right now. Just my thoughts.
Where do we go from here?
Well, and I would say too, as people are listening to this, especially leaders in our industry, here's where you go. I think first you understand, like, we're all dealing with inflation, and especially the workforce. So I think the first thing that companies need to look at is like setting up online financial well-being sessions for their employees and just having someone there to talk to them about how they think about inflation and budget and financial stress. Like, even talking about that to create a better game plan for employees and give them that option means that they'll be more productive because they'll have less stress. And I know sometimes companies don't want to do that because then, like, they have to talk about salary or benefits and all that stuff. But guess what? We're talking about it anyway. We're having to pay more to get talent or retain talent. But just having counselors, some kind of system that could help, or review the benefits that are available to employees they may not be taking advantage of. Things like that, I think, matter a lot, just to help people strategically think things through in our industry and our workers, how to get their hands around what's happening and better plan, not just for this year. That what we're talking about is a 5-year adjustment, I think. So I think we need to be thinking about that in terms of increasing productivity by helping reduce stress in our workforce.
Yeah. I mean, what's interesting, in California, there's a bill making its way through the legislature that would force companies of 500 employees or more to pay 40 hours a week wages for people who work 32 hours. So moving into a 4-day work week. And it's got momentum, and it may or may not pass, and it will continue to push companies out of California, which are leaving in droves. But it's an incubator for what kind of the next battlefield will be out there. It's not just wages; it's also, life, work-life balance, right, and creating, the government's dictating to companies what they can and cannot do in the marketplace. Andy, you were so right. You boiled it down to a market as a buyer and a seller coming up with a price. as is the employment marker is an employee and an employer coming up with the price for the work. And now you're going to have governments kind of forcing that in California if that initiative becomes law. And I just think the landscape's super squirrely right now and will continue to be. And companies have to be kind of weighing all these different factors that are swirling, let's go back to the churn word, right? It's just churning. And there's a lot to try and keep grasp of right now.
A lot of butter to be churned. Gary, we appreciate you coming on and help us churn that butter a little bit. I need to find some bread to slap it on. But the supply chains are pretty rough here right now, so I can't find any fresh stuff. I'll go off discount and see if I can find some stale bread and convince myself I toasted it as I crunch into it. So, but as always, I will remind people, all our members, Gary is our economist and does a great job of pulling together all our monthly reports. And we have reports on imports, we have reports on price, cost, we have reports on retail, we have reports on e-commerce, brick and mortar, and Gary runs all those and has for many years and has great insights. And so you can go into our FDRA.org Intel Center, and at the top, there's a little thing that says data and reports, and they're all right there, and they're always fresh. It's the latest data that we have up there in our analysis. We've actually worked to transform it to where it's a lot cleaner in terms of analysis, in terms of bullet points. So we know everybody's busy. They're doing more with less. And so we wanted to provide that analysis in a quick format. But part of that too is asking us for insights. If you have specific projects you want us to crunch numbers on, or analysis or consultations, we're happy to do that. We're very good, I think, at critical thought around some of these issues. And really that's what the show was about, is thinking a little bit more critically. Another C, just like this fills out my report card in high school, all C's, except for that F in chemistry. It's a different C. But really, I mean, we're here to help through this. And our mission at FDRA is to strengthen the footwear industry and our membership. And that's what we're trying to do, looking at these issues, helping companies plan ahead and prepare and scenario plan. But equally, the workforce out there. I mean, this is a difficult time when you're thinking about how you're allocating your funds, the new constraints that we're seeing, in the marketplace and in the workforce marketplace too. So if we can help along the way, please let us know. But I would encourage, as we look at this, and I know the great thing about this podcast is we have a lot of CEOs and a lot of C-suite folks listening. But I do think if you're not doing it, I think it's a great thing to do. Is just a financial review where you can get some consultants in to help employees just think things through, because it is a massively complex time to think about this. And if anything you get from this takeaway is this is not transitory. We're in a different epoch, both in the footwear industry and pricing, but also just in our economy and in our lives, I think. And so thinking about it that way, I think, you could provide some real creative services for the workforce to develop it better and help it increase its productivity and hopefully decrease costs and find new innovative ways forward. So with that, I'll stop rambling. But Matt, do you have any final takeaways before we dip off the show?
No, man. I think you hit it all on the head, and this is a to be continued conversation that happens every week on our Tuesday weekly call. So thanks for teeing it up, and I'm out of C's at this point, so we got to close out the show.
I'll give you one, folks. Thanks for listening to Shoe In Show. I'll see you later. We're out.
Shoe In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.